Hello, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, markets analyst at FX Pesa. So today we'll go through the key events of the day, especially the US PCE price index, how it influenced the markets, and try to understand our way forward. So once you join in, kindly say hi on the live comment section, and these will confirm that everything is working just fine. So let's begin by going through the outcome of the news, try to understand what happened. And once we understand that, then hopefully we'll understand where the markets might be headed next. So we had quite a set of news coming up at 4:30 p.m. So the very first instance was the GDP from Canada. So GDP growth rate annualized came in at 1%, which was higher than consensus estimates of 0.8% and higher than the previous reading of negative 0.5%. So growth rate quarter over quarter was 0.2%, up from negative 0.1% in the previous reading. And this shows that the Canadian economy is resuming growth. This is good for Canadians, but also for the Bank of Canada, which has been looking to slow down the economy. It's not looking that rosy. It's not something they've been looking to achieve. So besides that, the key highlight event for the day was the core PCE price index month over month, which showed an increase of 0.4% in February, and this was much higher than expected. The previous reading was an increase of 0.1%, but then the consensus estimate was 0.4%, which means that we are right on track. This was the expected number, and that's what we got. But then looking at other indicators on the same report, personal income increased by 1% compared to the previous increase of 0.3%. Personal spending was up 0.2%, slowdown from the previous reading of 0.7%. Then we had the PCE price index month over month. Notice that this one is not core. Core means that you exclude the volatile items such as food and energy. So PCE price index month over month was up 0.3%, and this was as expected, and it's an increase from the previous reading of 0.1%. So PCE price index year over year was up 2.4%, and when you compare the previous number, which was 2.6%, it means that the inflation is moving towards the Fed's expectation of 2%. So core PCE price index, which is now the heaviest data point that we have been focusing on, was up 2.9% in the previous reading. It slowed down to 2.8% as expected. So looking at this data and trying to understand how it impacted the markets, we all know that there is this expectation that inflation moves towards target gets to 2%, and from that point, we start seeing the Fed cutting interest rates. However, 2.8% is still significantly high. It's just 0.1% down from 2.9%, but also for the month, this is quite a big increase from the previous reading of 0.1%. So this shows that there is some signs of inflation being sticky within the US economy, and that's the concern that investors have been having with the data point. So judging from the previous readings, you can see we have had consistent drop in core PCE price index annual change, with the last reading being 2.943 and now 2.849. We are still moving well towards the 2% target, but still, when you look at how investors have been pricing in potential rate cuts, then we know that there's still quite a distance to go, and as a result, that's why we had the weird market reaction earlier in the day. So we'll be going through the charts in trying to understand where the markets might be headed. And once we understand that, hopefully we'll understand where the markets might be headed next. I'm seeing good comment. Hi, the name is from a Praise and Worship Impact Ministry. Welcome to the session, and thank you for joining us. So let's go through some charts and understand where the charts might be headed next. So what we are looking at here is the USDN, but I would like to start with the dollar index. So during the news announcement, we saw the dollar index weakening, or rather moving further downside. But then in the last 2 hours, we have seen a very strong spike or rally in the dollar index, indicating that investors are still betting heavily on a very strong dollar, and this is being seen across board. So the other big reaction we saw was in gold, basically breaking outside this diamond formation and moving all the way to an area we had identified as a target, which is the 2047 price level. So we saw the market basically jumping to that area, and now it's holding onto that. Hopefully, we will be seeing some form of reversal happening from that level. So other reactions that we might have seen in the markets includes the Nasdaq making a jump towards the upper side of the flag, and now it has pulled back down to the same area and then back up. So quite some volatility in there. The US 30 jumped higher and then pulled back, and the US 500 made a big spike up and now has pulled back, and we could be seeing some more volatility going forward. Whereas Brent oil has just made a reversal and a jump towards the upper side of the range. So Bitcoin had a big rally yesterday. So today it has been a consistent attempt to move higher, but then over the last couple of hours, what we are observing is the market basically moving sideways. So those are some of the key observations. And of course, for pound USD, it jumped higher and now it has changed direction and is further dropping against the dollar. If you look at Euro USD, it made a jump higher, but now we are seeing a reversal where the Euro is now losing to the strong dollar. And for USD JPY, there was a jump all the way down to our target, which was 149.516. Moved slightly lower before changing direction. And in the last 2 hours, we have seen an impressive recovery. So now it's the dollar taking control and gaining against other currencies. So let's move on. So for the projections for the day, I think it's reasonable to expect the dollar to continue moving upwards. So from this strong momentum right here, it's reasonable to expect that the dollar is in control. And now investors are betting on a stronger dollar going forward, having seen that inflation remained sticky for that period. So let's go through some of the articles we have seen coming up from the news event and try to understand where other analysts are projecting the market to be headed. So I'll be starting with this article here. US stocks fell heading into the afternoon trading on Thursday, as today, with S&P 500, the Nasdaq, both showing the decrease of around 0.1%, while the Dow Jones fell over 100 points following the release of PCE data. PCE prices in January saw a 0.3% increase month over month, up from 0.2% in December, and the core index rose 0.4% from 0.1% as expected. Earnings updates were also in focus, with Okta soaring 21% on strong quarterly results. In contrast, Snowflake shares plummeted 20% amid news of the CEO's retirement and weak revenue guidance. February has been positive overall, with the Nasdaq leading with a 6% gain, followed by the S&P 500, which gained 5.1%, and the Dow Jones gaining 2.3%. This marks the Dow's first 4-month winning streak since the May of 2021. Sorry, I wasn't sharing that specific tab, so I would rather try and share this with you guys so that you can read it on your own time. So hello, Yasmin, Holyfield Bush. Good comment to check on GBP USD. So for those who are new, GU is short for GBP USD. Please analyze the FTSE UK 100 index. I've seen that. Thank you, guys. Hello, Willibet. Thank you for joining the session. So let's move on to one more article that we have seen this afternoon and try to understand where things might be headed. So this one is from Yahoo Finance. Fed's preferred inflation gauge logs the lowest annual rise since March 2021. So the Fed's preferred inflation gauge logged its lowest annual increase since March 2021. In January, matching Wall Street forecast, while monthly prices rose at the fastest rate in a year. So this was the surprising thing. Even though the annual one was weakening and dropping to 2.8%, the monthly increase in core PCE price index prices rose at 0.4%, which was the fastest rate in a whole year. So the core PCE index, which strips out most of food and energy and is closely watched by the Federal Reserve, rose 2.8% over the prior year in January, the slowest annual increase since the 2.2% increase in March 2021. Compared to the prior month, core PCE rose 0.4%, and this was the most since January 2023, and an increase of 0.1% seen in December. The monthly increase marked a stark shift in the inflation data. Prior to Thursday's release, the 6-month annualized rate of price increases had been below the Fed's 2% goal for 2 consecutive months. After the January data, the 6-month annualized PCE price index increased is 2.5%. So notice that the annualized 6-month annualized rate was below 2%, which is the Fed's target. And this was leading to the assumption that the Fed will now consider cutting interest rates. But now, after getting the January data, the 6-month annualized rate basically jumped higher to 2.5%, meaning that the goal of getting inflation below 2% is further moving away. And as a result, this may force the Fed to continue holding rates higher for longer. And with that narrative here and understood, then we know that the market reaction was just to the data point, but the overall picture is indicating a potential where rates might stay higher for longer, bond yields could continue holding higher for longer, and as a result, we could be seeing much stronger prices. So from this chart, you can see the change in core PCE since 2016. So we had the highest level back in 2022 around March, where it was 5.9%, managed to drop below the Fed's target at 1.9%, and now we have a big jump to 2.5%, which makes the battle against inflation much harder. So headline PCE, which includes all categories, logged a 2.4% increase over the last year, a slowdown from last month's 2.6% print. The print comes at a crucial time in the inflation story. After another reading on price increases, the CPI recently slowed. Prices grew faster than expected in the month of January. The hotter than expected report sent stocks lower and prompted investors to shift their interest rate cut expectations. So from this, now if we go to the FedWatch tool, which is the CME FedWatch tool, then we'll see the key changes that we have been anticipating. And this is a tool that considers the CME 30-day Fed funds futures to estimate the probability of the Fed changing interest rates. So this website can be quite slow in loading the data, but as it loads, hopefully we get to understand a way forward. So just a moment. All right, the data has loaded, and now as you can see, at the beginning of the year, the probability of the Fed holding interest rates steady was about 10%. So as we got more and more data up to date, which is the 29th of February, this probability has moved from 10% all the way up to 97.5%. So probability of cutting interest rates on the March meeting was above 73%, and now it has dropped all the way down to 2.5%. So this means that the market is heavily pricing in a potential that the Fed will hold interest rates higher for longer. And now when we move to the next meeting, the next Fed meeting after 20th March will be on the 1st of May. So this will give you an idea of what to expect. And for the May meeting, there is investors basically speculating that the Fed will still hold rates higher for longer, with a 78.6% probability, whereas 20.9% is betting on a potential rate cut of 25 basis points. So if you move this forward to now the 12th of June, which is the mid of the year, now there is a higher probability of the Fed now cutting rates by 25 basis points to 5.25%, down from 5.50%. However, there is still a significantly high probability of 35.6% that the Fed will still hold rates higher. And remember, the Fed is data dependent, so investors are basically focusing on the data to try and speculate the direction of interest rates. So those who are new to this, why do these interest rates matter? Interest rates being charged by the Fed basically imply the cost of borrowing funds within the economy. So commercial banks will take this on and transmit this to the economy. So if interest rates are at 5.5%, they also impact the rate at which the government is borrowing. For instance, if you're in Kenya, and we know that the central bank increased interest rates to 13%, then we know that the bond yields are also rising, and where the government is now attracting more investors to buy more bonds. So when interest rates are high, then bond yields tend to be higher. There's a very strong positive correlation, and as a result, we tend to see more money moving to bonds, which tightens the economy and strengthens the currency. So it's a similar thing in the US. So whenever you see interest rates rising, bond yields are also rising. So it attracts more capital towards bonds, and as a result, the currency strengthens. So you find that more investors are willing to buy the dollar and then use the dollar to buy bonds. They basically sell the dollar to the US government or basically lend it to the government. And for doing that, they get some nice yield. And that's what has been the major contributor of the dollar strength. So with this in mind, if you're expecting that the Fed will hold rates steady at the current level up to June, then that means that there is the month of March, April, May, and June, 4 months. So within those 4 months, you can literally invest in the US Treasury, and out of that, you would get a good yield with very little risk. So I'll try and identify one. Hopefully everyone will be able to see this. So I'm searching this on the CNBC website. So just a moment. Yeah, the tab is up. So as you can see, the 1 month treasury is yielding 5.395%, and it's up 0.001 today. 3 month treasury is 5.375%. So remember, the yields are annual. So if you invest for 3 months, it doesn't mean that you'll get the 5%, but rather you'll get a good return based on your investment, which is basically a quarter of this. So 3 months is basically a quarter. So it's 5.375% divided by 4. So this tends to be really good, especially for institutional investors, such as retirement funds. And when yields are good, they will pack a lot of money there, and the economy will be left with less money, which tends to strengthen the dollar across board. So knowing this and knowing that inflation is still a problem, that may explain why we are seeing what we are seeing, which is a very strong dollar across board. So let's look at the charts and see how the markets are reacting to this information. So first instance, the dollar weakens as inflation did not come up higher than expected. So there was an instant reaction where investors were selling the dollar, basically because inflation was moving as projected. But then once they dug deep into the report and understood that the big jump is affecting the 6 month moving average, and as a result that the Fed may consider holding rates higher for longer, then we have seen the overall reaction and the dollar regaining its strength. So what has happened on USD JPY was early morning news showing that inflation is really high in Japan at 2.6%. And as a result, we expect the Bank of Japan to consider hiking interest rates. So later on in the afternoon, a further drop after the announcement of the CPI report. But then the investors dig deeper and realize that this is not good news for the Fed. And in this case, rates might have to stay higher for longer. So that move is being raised as we speak. And now we could start looking into the morning's move, which basically implies that the dollar index could potentially move higher. So it's not every day that you see a candlestick like this one, a small green body with a long tail towards the lower side, indicating rejection of lower prices. And now the bets are in. Basically means that there is a good likelihood that the price will now fully recover and potentially get to the previous high of 150.866. So for Euro USD, it's the similar story, a big jump, and now the market is headed lower. So remember, our support is based on yesterday's low. So the market is headed there, and once it gets there, we'll be looking to see if the market potentially breaks that level. So a break would mean that we now face further downside momentum for Euro USD. So from the forward chart, this is how it looks like, and there's a likelihood that the market may extend the drop and potentially get all the way down to the previous low of the last 2 weeks. So pound USD is also doing the same thing. So after breaking this trend line, I remember discussing this with you guys that you've had this trend line holding through for the month of February. Then a breakout happened yesterday. The market pulled back, retested the area, and now today we are seeing an extension of this momentum. So as we all know, if a market breaks and retests and then continues in that direction, then it often signals a reversal. And now we might be expecting to see some further downside momentum. So going into Friday, then there is the expectation that the pound continues weakening to the dollar and potentially gets to 1.25787 price level. So USD CAD, you can see the dollar resuming strength. So this is a pretty simple trade. Now we will be looking at the previous high. So the potential for the market making a recovery and get to this previous high is really significant. So as for gold, there was a big jump upwards, but then the moment we got to this resistance, we can see that the market is now changing direction, and it might take some time to recover. So going back to 2027 price levels is kind of reasonable. So I expect gold to take time to make this drop, but then the reversal is expected either way. So remember, if you're holding on to gold, it doesn't yield cash flows. But then if you're holding on to the dollar, and this is thinking from an institution way, we know that if you're holding onto the dollar, you don't just put it in a reserve, you put it in a government treasury or government bond, and it will give you cash flows from the yields from that bond. So as a result, it's more reasonable to put your reserves in the dollar compared to gold, because the dollar gives you a good return coming from the high interest rates environment. So in this case, we expect the dollar to resume strength and as a result, reverse the entire move in gold. So US equity indices made a big jump, pulled back. So I think the only thing we can do is to extend the flag to accommodate the new price level. So we are still trading within the flag. So now we await yet another potential breakout. We are still trading within the flag, so we wait for another breakout, and it's the same thing for these other indices. So as for now, seems more likely that there will be a downside reversal. Stocks slow down. For the S&P 500, there was a big break up and now a pullback. So we could be extending the flag to accommodate the new price, but all the more the market is still within a flag. So Brent oil made a strong rally. Now you can see a reversal. It seems mixed up. So the potential areas to make a market entry include this area here, which has been acting as resistance. So if Brent oil was to break above this, that would be an easy bullish position. But then if it remains within that area, then the other potential area to look for opportunities is around this area here. So as long as it remains within the range, the opportunities may not be as fruitful as when you're trading the extreme prices. So European equity indices are basically moving sideways. I would say for what? This is quite a number of days. This is like 5 days. 5 days of sideways momentum. So we don't have much activity, even though there is a slight bullish momentum. So the slight bullish momentum is following this path. The market, yes, is alternating between the two, but it's more of a sideways range. So we would best be positioned if you expected or remained patient until there was a breakout. So French 40 index still sideways momentum. I remember discussing this in the morning during the market snapshot. So we don't have much of an activity here. So a potential breakout would present a nice opportunity. And I remember there was a request at the beginning of the session where someone asked that we analyze the UK 100. So there was an expectation that we continue seeing further upside momentum. However, that has seemingly failed. So what we are seeing here is, I'll zoom out, a market trading inside a flag. So if you think of this momentum as a very strong bullish momentum, directional movement, then the price action after that is more of a flag. Market trading between two trend lines and not making any progress. So we are just swinging up and then down, and now we are on a downswing. So potentially the market might be headed here, but the real good opportunity will be once the market breaks out of the flag. So for very short-term trading, the expectation is that the market gets to the lower side of the flag, but then the best opportunity is if the market breaks either of the two trend lines. So now I'll be checking to see if there's any questions as we approach the end of the presentation. I think I've answered the question on GU, that's pound USD. Pound USD, straight, strong, bearish momentum. So we just have to observe this area here, see if there's a clean breakout, and then continue trading lower. But for now, the momentum is strong enough to justify the market continuing and breaking below this support and potentially heading to 1.25787. So we have already analyzed gold too. So I think that answer is answered. I've answered the question on UK 100. Hey, J Squad, thank you for joining the session. How do you buy US Treasuries? I wonder why you would really want to go for US Treasuries. On the FX Pesa platform, we don't have US Treasuries, but we have Gilts, which is an index for UK bonds. So I think the instructions on the US Treasury website, you'd rather just check it out. Hello, Tony Dark, and thank you for doing the session, Masi Anzanzi. I don't know if that's the pronunciation. About yields, how do you buy long-term? So when bond yields are good, you bet on the currency. That's the obvious way as a Forex trader. You don't have to hold on to a bond for a year. So the best way is to trade the dollar as a strong currency against the weak currency as long as yields remain higher. But then if you're looking to trade bonds, the better alternative is to check out the US Federal Reserve, US Treasury website. What are your projections for quarter two? Quarter two, I think we should be seeing some potential tracking back from the US equity markets. They've been pretty strong for the past 1 year and the past 2 months of the year. So at some point, I expect to see some form of correction, and that's my projection for the second quarter of this year. A good question here from Samuel. What's your take on the bull run for Bitcoin? What is to be expected as we go for the halving? So what we are seeing right now is a surprise shock, basically meaning that there is an imbalance between demand and supply, where there is a significantly high demand for Bitcoin compared to supply. So if you track the number of purchases that the ETFs are making versus the amount of Bitcoin that miners are adding to the Bitcoin economy, then there's a huge difference. So as a result, this is driving prices higher. And what we're expecting going forward is literally the rewards that miners get every time being reduced by half. And as a result, the supply shock gets even worse. So with the what imbalance between Bitcoin demand and Bitcoin supply, then my projection is that price continues to rally higher. So a good question here from Holyfield. What time frame do you use during market analysis? I try to use different. time frames, but most of the time you'll find me alternating between the 1 hour and the 4 hour time frames. They tend to serve different persons differently. So there's a shorter term traders and longer term traders. So when I switch to the 4 hour time frame, you get to view at least the bigger picture. In the 1 hour time frame, you get to view the smaller picture. So when I'm doing the analysis, always check this section here. It's highlighted always. So you are able to tell the time frame by just looking at this section, where H1 represents 1 hour, H4 represents 4 hours, daily, 15 minutes, and so on. Sometimes you'll find me juggling through the time frames, and you can always check this section to know which time frame I'm focusing on. So another good question, how do you know that the Fed is going to cut interest rates, and when it's a cut is to sell or buy? So I think I just explained this area in the presentation, that the Fed is fighting against inflation, and if inflation remained towards the Fed target of 2%, then the probability of the Fed cutting interest rates increases. So you can check that using the CME FedWatch tool, which basically shows you the probabilities. So in that case, interest rates remaining high creates demand for the dollar and demand for US bonds, and as a result, strengthens the dollar. So in that case, it basically implies we continue seeing a dollar that is reasonably strong against other currencies. But then if it's the other way around and the Fed is now cutting interest rates, then this creates panic, leading to a much weaker dollar. So I hope that answers the question. If you joined in late, kindly go through the recording. It will be live on YouTube, and hopefully you'll get a much clearer picture, because I think I took over 5 minutes trying to discuss the same thing. Another good question is anyone late on buying Bitcoin now for holding? No, you're not late. You are too early. There's still much more that is in store for Bitcoin. And I expect to see some further momentum upwards. And at the same time, if your goal is saving for the long term, then Bitcoin has a record of making sure that those savings don't lose their purchasing power. It has been the best performing asset in the market for the last 15 years. So next question here is from Kevin. Hey Rufas, how come both gold and dollar are upward after the news, yet they are often inversely correlated? So what I'm saying is that the initial reaction was that the news came in as expected, inflation is going down. So the instant reaction, especially from news traders, was that inflation is going down, then this basically means a weaker dollar. So there was a slight weakening of the dollar, and other currencies gained against the dollar. So one of the assets that really gained against the dollar was gold. But now we start thinking the other way around. So now that you have seen the fuller picture, I think I covered this significantly earlier. We know that the Fed is potentially going to hold rates higher for longer. And as a result, now people are processing that information, leading to the big sell-off in other assets against the dollar. So now the dollar is making a very strong and impressive recovery. And this basically leads to the potential for gold making a full reversal from the recent spike. So that's my analysis and expectation. As always, these sessions are not investment advice. They are not a recommendation to trade. So you should always do your own due diligence. And thank you, everyone. Thank you for your time. Thank you for joining the session. I hope to see you on the next session. That will be next Monday. Enjoy your Friday as well as your weekend. And remember, there is a new episode of the Bullish Banter podcast available on all podcast platforms, including YouTube. And you should try and check it out. I can guarantee you there's some good stuff in there. So that's it. See you guys on the next one.